Hello everyone. Today, let's dive into a topic that's making waves across global economies: the impact of easing inflation on emerging markets. This issue doesn't just shape economic policies, it directly affects people's daily lives. Since late 2023, global inflation has been easing. In the US, inflation fell from a peak of 9% in mid-2022 to about 3% by the end of 2023. Similar trends are playing out in the EU and other developed economies. But for emerging markets, the story is more complex. While some benefit from falling commodity prices and improved supply chains, others are still struggling with high inflation due to currency depreciation, fiscal deficits, and energy dependence. Take Argentina, for example. Imagine living in a country where prices double within a year. That's the reality for many Argentinians. By early 2024, inflation had skyrocketed to 211.4%, one of the highest rates globally since the 1990s. The government tried quick fixes like freezing utility prices and tightening foreign exchange controls. But these measures haven't tackled deeper issues like fiscal deficits and reliance on volatile global markets. On the other hand, India presents a more optimistic picture. Through targeted food subsidies, agricultural export regulations, and investments in domestic production, India managed to keep inflation below 6%. According to the Reserve Bank of India, these measures stabilized food prices and maintained consumer purchasing power, even as GDP growth slowed to 5.4% in the September 2023 quarter. Now let's talk about capital flows. The US Federal Reserve's rate hikes in 2023 pulled significant capital back to the US, depreciating currencies in emerging markets like Brazil and South Africa. For example, Brazil's real lost nearly 10% against the dollar, making imported goods more expensive. To stabilize its currency, Brazil's central bank raised interest rates to some of the highest levels globally. But this came at a cost. Higher rates squeezed domestic lending and slowed economic growth. Let's take a closer look at consumer behavior. During periods of high inflation, Turkish households saved more and spent less, which slowed down the economy. But as inflation eased, consumer confidence started to recover. According to the Turkish Statistical Institute, the Consumer Confidence Index rose from 75.6 in mid-2023 to 81.9 in early 2024. While this rebound in spending is promising, focusing too much on short-term consumption recovery could risk neglecting the need for long-term economic resilience. So, how can emerging markets respond? First, they need to stabilize exchange rates to avoid excessive capital outflows. Second, building strong local supply chains is critical. Take Indonesia as an example. By investing in domestic industries and infrastructure, it has reduced reliance on imports and eased imported inflation, demonstrating the value of local supply chains. But these efforts require significant upfront investments, which could strain fiscal budgets. For global investors, emerging markets remain highly attractive. Sectors like infrastructure, digital transformation, and green energy are booming. Vietnam, for instance, saw substantial foreign investment and achieved an impressive 8% GDP growth rate in 2023, according to the World Bank. However, challenges like labor shortages and environmental concerns could slow its progress if not addressed. The easing of global inflation presents both challenges and opportunities for emerging markets. How these countries navigate their responses will shape their economic futures. What do you think? How should emerging markets balance these challenges and opportunities? Share your thoughts in the comments and let's explore this fascinating topic together.